This chapter is a short, practical how-to, a compact checklist that tells you what to look for when you found a stock worth investigating. Lynch's point up front is reassuring. You don't need to become an accountant or spend weeks doing this. A couple of focused hours per stock will usually do it. The trick is to do the right checks and to do them with the appropriate expectations for the kind of company you're evaluating. First, the general rules that apply to every stock. Check the P/E ratio. Is it high or low relative to the company's history and its peers? Look at institutional ownership. The fewer big institutions own it, the more likely you found something overlooked. Insider buying and company buybacks are positive signs. Management putting skin in the game or shrinking the share count aligns interests with shareholders. Look at the earnings record. Have results been steady or erratic? Finally, check the balance sheet and cash position. Lynch gives the Ford example. When Ford had about $16 of net cash per share, that set a practical floor under the stock and changed how risky it felt. Then the chapter breaks the work down by the 6 stock categories Lynch uses throughout the book: slow growers, stalwarts, cyclicals, fast growers, turnarounds, and asset plays, and gives the specific items you should verify in each case. Slow growers. These are dividend plays. Your first question: will the dividend hold up? Look for a long history of steady or rising payouts. Find out what percentage of earnings the company pays as dividends. A low payout ratio gives breathing room in a downturn. A high one is riskier. Stalwarts, big, steady companies. The main concern is price. You want to know whether you're paying too much. Check the P/E. Watch for diversification, fancy unrelated acquisitions that dilute focus and hurt long-term profits. Check how the company fared in past recessions. Some stalwarts are great defensive holdings. Others were simply overpriced at the wrong time. Cyclical timing and industry knowledge matter here. Watch inventories and supply/demand trends, and be alert for new entrants that could push margins down. Expect that P/Es will compress as a cyclical industry recovers and the market looks ahead to peak earnings. If you know the cycle well, cars, steel, or airlines, for example, you have an edge. Fast growers. This is the land of 10 baggers but also of danger. Make sure the product driving the growth actually matters to the company. Look for demonstrated replication. The company has succeeded in more than one city or region, and room to expand. Check whether growth is slowing. 3 new stores last year, 1 this year is a red flag. Also, these tend to have few institutional owners early on, which is a plus. Turnaround survival is the first concern. How much cash, how much debt, and what is the debt structure? Bank debt that can be called immediately is dangerous. Funded long-term debt is safer. Understand the turnaround plan. Will bad subsidiaries be sold? Will costs be cut? Lynch gives Lockheed and Texas Instruments as examples where decisive action and sensible write-offs enabled a dramatic recovery. But be careful. Dilution, selling lots of new shares to raise cash, can ruin the upside. Asset plays. Here the key is valuation. What are the real assets and how much debt stands against them? Look for hidden assets. Real estate, cable franchises, mineral rights, tax loss carryforwards, and ask whether a raider or restructuring might unlock that value. But remember, creditors get paid first, so heavy debt can wipe out an apparent asset bargain. After the category-specific checks, Lynch ends with a list of practical pointers, rules of thumb that are worth memorizing. Among them, small companies move more, large companies move less. Be skeptical of companies claiming 50 to 100% growth rates. Avoid hot stocks and hot industries unless you have a solid reason. Be wary of diversification that becomes diworsification. Long shots seldom pay off. It's often better to wait until a plan is proven. Use your own edge, what you see at work, at stores, in your town, because those grassroots signals can reach you well before Wall Street. A few behavioral rules are sprinkled through the list. Separate the tip from the tipper. Don't buy just because your rich uncle likes it. Favor companies where management has a material stake. And devote at least an hour a week to real research, not just watching prices. Above all, be patient. Watch the story but don't watch the price every minute. The classic line, watched stock never boils.